Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Baidu.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today, we're getting into something truly wild. Imagine walking up to a business, asking to see their books, and realizing they literally have more cash sitting in their bank account than the stock market says the entire company is actually worth.
Yeah, it really sounds like a glitch in the matrix, honestly.
Right. You would instantly think one of two things. Either, the company is a massive fraud, or we're looking at one of the most extreme structural mispricings in modern finance.
It creates this really fascinating paradox. The market narrative has completely detached from the mathematical reality on the ground.
Exactly. So we're unpacking that exact paradox today with a legacy tech giant that you probably think you understand, Baidu. We've been looking over all the recent data, fundamental analysis reports, technicals, sentiment scores, the upcoming catalyst calendar.
And the mission here is really to just cut through the noise.
Because the broader market is pricing this company like it's just a dying legacy search engine. But the data suggests we're actually staring at an AI-first infrastructure powerhouse.
Yeah.
Just hiding right in plain sight.
Yeah, what we're witnessing across all these financial documents is it's the painful but absolutely necessary death of an old business model, to birth a new one.
Metamorphosis.
Right. And when a company undergoes a structural pivot of this magnitude, it just completely scrambles the traditional metrics that everyday investors rely on. It blinds the market. People are pricing the asset based on its historical identity, and they are entirely missing the new reality that's being built underneath it.
So let's jump right into that, the financial reality versus the headline numbers. Because if you were just skimming the news, I can totally see why people are panicked. For the full year 2025, Baidu's headline revenue actually showed a 3% year-over-year decline, bringing them to 129.1 billion RMB.
Yeah.
And if you stop reading there, you just see a shrinking company and you sell.
Exactly, because a top-line decline of any kind is exactly what sets off the algorithmic sell alarms across Wall Street. It just triggers this massive surface-level panic.
But the segment breakdown, it tells a completely different story. Their AI-powered business segment is exploding. It generated over 11 billion RMB in the fourth quarter alone.
It was just huge.
It is. That AI segment now accounts for 43% of their core revenue. That is up from just 26% a single year prior. And because of that massive internal shift, their Q4 2025 adjusted net income completely smashed estimates by 36%.
Coming in at 10.62 RMB per ADS.
Right. And before we go further, for anyone listening who isn't staring at foreign stock documentation all day, an ADS is an American depository share. It's essentially a certificate that allows U.S. investors to easily trade shares of foreign companies on U.S. exchanges without dealing with cross-border regulatory headaches.
And that 36% earnings beat per ADS, that is the crucial data point here. It demonstrates incredible operating leverage. They are squeezing significantly more profit out of these new AI systems than they ever did from their old models.
I do want to push back on that, though, because there is a genuinely terrifying number in the data for traditional investors. Their legacy search ad revenue dropped 18% in 2025.
Yeah, that's a big drop.
And the reports point out exactly how this is happening. Their own artificial intelligence, Ernie, it's getting so good at giving users direct answers that it stops people from clicking traditional blue links.
It cannibalizes the core product.
Exactly. Think about it. If I search for a recipe, Ernie just writes it out for me instantly. I don't click a food blog, so Baidu doesn't get that ad revenue. A company actively cannibalizing its own core, highly profitable product is terrifying. How is that not a massive red flag?
On the surface, it looks like pure self-sabotage, right? You are actively destroying the cash cow that built your empire. But if we analyze the mechanics of technological shifts, this is a textbook example of survival.
You have to destroy your own legacy model before a competitor does it for you.
Exactly. What the broader market is missing is the mechanism replacing those lost clicks. The data highlights a staggering 143% growth in their AI cloud subscriptions.
That is basically a vertical hockey stick on a growth chart. But how does a cloud subscription make up for millions of lost ad clicks?
It all comes down to the quality of the revenue. Ad revenue is transactional, it's highly volatile and increasingly low margin. Enterprise cloud subscriptions, on the other hand, are sticky. They're recurring and incredibly high margin.
So they are swapping an old, decaying advertising dollar for a premium, locked-in subscription dollar.
Right. That 143% growth is aggressively offsetting the 18% decline in the legacy search business. That massive earnings beat you mentioned earlier, that is the mathematical proof that the new engine is vastly more efficient than the old one.
But building that massive new engine, I mean, especially the physical server farms and the custom silicon required to run generative AI at scale, that is notoriously a cash incinerator.
Oh, absolutely.
Which brings us to the obvious question. How are they surviving that burn rate without endlessly diluting shareholders or taking on just crippling debt?
Well, this is where we return to that paradox you mentioned at the start of the show. They are funding this pivot because they possess what financial analysts call a fortress balance sheet. They are currently sitting on 294.1 billion RMB in total cash and investments.
I really want you, the listener, to visualize that number. That cash pile completely dwarfs the company's entire current market capitalization.
It's staggering.
Meaning, if you bought every single share of the company at its current stock price, you would spend less money than the actual cash they hold in the bank.
Yeah.
You would get the entire AI business, the search engine, and the robotics division, essentially, for less than free.
And that provides an unprecedented margin of safety for investors. It means they possess the internal liquidity to fund this highly capital-intensive AI infrastructure build-out without asking the public markets for a single dime. And management recently made a massive move to signal their confidence in this reality. They initiated a first-ever dividend policy and authorized a $5 billion share repurchase program.
Okay, I have to play devil's advocate here.
Yeah.
Usually, when a tech company starts paying dividends and buying back shares, it signals that their high-growth, innovative days are over.
That's the traditional view. Yeah.
Right. It's an admission that they have run out of disruptive ideas to invest in, so they just hand the cash back to the shareholders. Is management accidentally waving a red flag disguised as a green one?
That is certainly the traditional way to read tech dividends, especially in Silicon Valley. But the context of a structural pivot changes the math entirely. In this specific case, the shift from pure cash-burning growth investment to returning capital marks a vital maturation point.
How so?
Well, first, it proves that the heaviest, most expensive phase of the infrastructure pivot is largely complete and fully funded. Second, it demonstrates management's extreme confidence in the cash flow generation of the newly established AI business.
So they aren't hoarding cash out of fear of the future.
Exactly. They are returning it because the new cloud engine is printing it reliably. It establishes a massive valuation floor for the stock.
Okay, so having a war chest of cash and buying back stock provides a safety net. But cash alone doesn't guarantee you win the global AI race. You actually have to build a product that enterprise clients demand. What exactly is Baidu selling that their competitors aren't?
Their primary competitive moat comes down to two words: vertical integration.
Owning the whole sandbox.
Precisely. While many of their competitors are scrambling, relying on expensive third-party hardware from companies like NVIDIA or bolting disparate software systems together to make things work, Baidu owns the entire stack.
This is ground up.
Yeah, they design the physical silicon, their proprietary Kunlunxin AI chips. They build the software brain, their ERNIE 5.0 foundation model. And they control the distribution mechanism, the Baidu AI Cloud.
And the data highlights a specific new product launched in this stack called DuClaw. They describe it as a zero-deployment service for enterprise AI agents. Walk me through the mechanics of that. What does zero deployment actually mean for a business?
No, it is the ultimate magic word for any enterprise IT department. Normally, if a logistics company wants to build an AI agent to handle their customer service routing, they have to hire a team of incredibly expensive machine learning engineers.
Rent external server space.
Right, string together multiple APIs and spend 6 months debugging it. Zero deployment means Baidu has already done all of that heavy lifting on their own servers. The logistics company simply subscribes, plugs the AI directly into their existing software, and flicks a switch.
This strategy reminds me so much of Apple in the early days of personal computing. When everyone else was building software to run on other people's hardware, Apple decided to build the Mac, write the operating system, and own the entire user experience end to end. Is this full stack control the secret to locking these enterprise clients in?
The Apple analogy is perfect here, and it absolutely is the secret to their moat. Consider the switching costs. When an enterprise adopts a deeply integrated system like DuClaw, they aren't just buying a software
They're
license.
changing everything.
Yeah, they are restructuring their internal workflows, their customer service logic, and their internal data pipelines around Baidu's entire ecosystem. Everything from the custom chip processing their data to the cloud hosting it is proprietary to Baidu.
So if that client ever decides they want to switch to a competitor, they have to rip out their company's entire digital nervous system and rebuild it from scratch.
Exactly. And for most large enterprises, that becomes practically impossible, or at least prohibitively expensive.
Okay, so the business fundamentals are rock solid. They have the cash, they have the full stack proprietary tech, and they have the enterprise clients locked in with massive switching costs. Which forces me to ask, if everything is so incredibly strong, why does the stock chart look like a disaster?
It's rough out there.
Our technical data shows the stock has plunged 33% from its 52-week high, and it's currently trading around $111.
It comes back to the psychological lag of the broader market. Retail investors are still obsessing over the 18% drop in legacy search revenue, completely missing the enterprise cloud growth.
And the technicals show that retail fear has reached a fever pitch. The stock is deeply oversold, currently sitting at an RSI, a relative strength index, of 30.0. For you listening, an RSI is a momentum indicator. When it hits 30, it basically means the selling pressure has reached a point of absolute mathematical exhaustion.
It's like a rubber band.
Right, it's like a rubber band that has been pulled back as far as physics will allow before it just has to snap back.
Adding to that, the technical data identifies a bullish fair value gap sitting right between $108.30 and $111.13.
Stop there, because bullish fair value gap sounds like high-level Wall Street jargon. What is that, mechanically?
Think of a fair value gap as a pothole in the market's price history. It happens when a stock drops so violently and so quickly that buyers don't even have a chance to step in at certain price levels, leaving a gap in the trading data.
Okay.
Eventually, the market almost always returns to fill that gap because institutional buyers recognize it as a zone of extreme, irrational discount. It acts as a massive area of structural support.
Which brings up a wildly interesting data point from our sentiment tracking. While everyday retail investors are panic selling because they see the stock price dropping, an insider at the company recently purchased over 95 million shares.
That is massive conviction.
Plus, massive institutional players like PrimeCap Management and Morgan Stanley are holding their positions completely steady. What does the smart money see here that the average investor scrolling a brokerage app is missing?
Institutional players build their fortunes by separating market noise from business structure. They use these periods of maximum retail pessimism to accumulate highly valuable assets at deeply depressed levels. When the stock dips into that fair value gap, the smart money actively defends their positions.
Because they know the real value.
Right. They are looking at the analyst consensus targets, which currently sit at $176.40, representing nearly a 59% upside from current levels. They have run the math and realized that the negative sentiment surrounding the old ad business is vastly overpriced relative to the incoming trajectory of the AI cloud business.
They are buying the new engine while everyone else is aggressively selling the old one. But before we stamp this as a flawless investment, we have to look at the external pressures. You cannot analyze a foreign asset of this size without addressing the massive geopolitical cloud hanging over it.
Yeah, the macroeconomic reality is often the heaviest weight on the stock.
The reports outline geopolitical exposure as the primary external risk. Specifically, we constantly see U.S. lawmakers urging the delisting of Chinese firms from U.S. exchanges. That threat alone scares billions of dollars of capital away. How do you logically price in a risk that seems to change every time a politician gives an interview or a news headline breaks on the other side of the world?
You can't predict headlines, and you really shouldn't try. What you must do is analyze the structural backstops and treat geopolitical events strictly as objective market variables.
Give me an example of a structural backstop here.
Well, the data points out that Baidu has a potential upgrade of its Hong Kong listing to primary status.
Meaning if they do get kicked off the U.S. exchange, the stock doesn't just vanish into thin air.
Exactly. It provides a structural backstop. The equity simply has a new primary home in Hong Kong. Furthermore, we have to look at the macroeconomic de-escalation signals that are currently tracked. Specifically, the recent U.S.-Iran ceasefire and de-escalation signals from the Trump administration.
And to be clear, we aren't taking political sides here. We are just looking at how these events move markets.
Purely as market variables, yes. What you're watching when those de-escalation signals happen is the deflation of what analysts call the regulatory risk premium.
The invisible discount the market applies strictly out of fear.
Yes, exactly. Right now, that premium is suffocating the stock's valuation, keeping it artificially low. When geopolitical tensions cool even slightly on a macro level, that risk premium shrinks. And when the premium shrinks, it allows the stock price to naturally float back up closer to its true fundamental value, completely independent of how many AI subscriptions the company sold that day.
Okay, so the stock is fundamentally undervalued, technically oversold, structurally defended by smart money, and sitting on an impenetrable cash pile. But anyone who has ever invested in a value stock knows that a value trap can stay undervalued forever if nothing happens to force the market to pay attention. We had a spark.
We do.
What are the actual events of the upcoming catalyst calendar that could force Wall Street to wake up?
The catalyst calendar for the next 3 months is actually incredibly dense, which is unusual. First, we have the Q1 2026 earnings arriving in late May. Institutional investors are going to be laser-focused on one metric, that AI cloud subscription revenue.
What's the number they need to hit?
The consensus target to watch is anything north of 40% year-over-year growth. If they hit or exceed that, it provides undeniable proof that the pivot is accelerating faster than the legacy decay.
And it isn't just software and server farms. There's a massive physical world catalyst on this calendar. The commercial launch of Apollo Go robotaxis in Europe. The details specify rollouts in Germany and the UK via a partnership with Lyft. I have to pause on this. We are talking about Chinese AI systems autonomously navigating the streets of London and Berlin.
We are. And the partnership with Lyft is the strategic masterstroke there. Baidu doesn't have to navigate the local regulatory hurdles or build a consumer app from scratch in a foreign market. Lyft handles the local logistics and customer acquisition.
While Baidu simply provides the underlying autonomous tech layer.
Exactly. And there is also unconfirmed chatter regarding potential strategic partnerships with global ride-sharing giants following their recent Uber launch in Dubai.
If that European expansion scales even slightly faster than expected, it changes the entire narrative from a domestic software story to a global robotics story. But out of everything on this calendar, the single biggest catalyst, the one that completely changes the math, is the spin-off and Hong Kong IPO of their Kunlunxin AI chip unit.
Yeah, that is the major near-term event that could break the stock out of its slump.
It reminds me of a real estate analogy. Imagine buying a beat-up, ugly old house for incredibly cheap because the roof is caving in.
Right.
But after you buy it, you go into the attic and find a pristine, priceless Picasso painting hidden under a tarp. You don't try to sell the ugly house for more money. You take the Picasso out of the house, take it to an auction, and sell it separately for a fortune.
That is a brilliant way to conceptualize how corporate spin-offs function when a parent company is deeply undervalued. Right now, because Baidu is seen as a struggling search engine, the broader market is giving them almost zero credit for owning a proprietary cutting-edge AI chip manufacturer.
The value of that silicon division is just trapped inside the depressed stock price.
Exactly. By spinning the Kunlunxin unit off into its own IPO, Baidu forces the public markets to assign a standalone, highly visible valuation to that specific asset.
It unlocks all that hidden value that retail investors couldn't see.
It does. It forces analysts to update their sum-of-the-parts valuations. This IPO serves as the near-term spark that could ignite what is fundamentally a multi-year compounding growth story.
So let's bring this all together. What does this mean for you, the person listening to this right now? If we distill the fundamental analysis, the technical charts, the insider buying, and the upcoming catalysts, the final thesis points to an 8 out of 10 bullish multi-year hold. We are looking at a fundamentally misunderstood AI infrastructure play. It is trading at distressed valuations, it's backed by a fortress balance sheet that literally exceeds its market cap, and it has an imminent chip IPO acting as a massive catalyst to unlock trapped value.
It serves as a profound lesson in not letting market sentiment or terrifying headline numbers like a drop in legacy revenue blind you to a fundamental corporate transformation.
You have to look past the decaying ad engine to spot the high-margin enterprise subscription engine they are quietly building right underneath it.
And this raises an important question, something for you to mull over after we finish up today. We talked extensively about Ernie cannibalizing search clicks by giving users perfect answers instantly.
Yeah.
If a foundation model can synthesize the exact information a user needs without them ever needing to click an outbound link, visit a website, or view a traditional display ad, What does the future of the entire internet economy look like for the thousands of companies that don't own their own AI infrastructure?
They are the ones entirely unprepared for the future. Thanks for joining us. We'll catch you next time.